In this video, we're going to look at VMware. They're a software company located in Palo Alto, California. What I do in my videos is I run a discounted cash flow model. This way I could figure out the actual value of the stock. And I also look at the financial ratios of the company and compare them to its competitors. So let's get started with the model. First, we need a market cap, which is $62.8 billion. And then we're going to get the stock price, which is $149.88. And we next need the free cash flows. And free cash flows is cash flow from operations minus capital expenditures. And this is how you value a company or you value any asset. You have to estimate the future cash flows and then discount that number back to today's value. And that's what I'm doing here in the video. We also need the net income, which is the profit and loss according to the income statement. And we need the revenue, which are the sales for the business. That's also in the income statement. So the numbers look pretty good. They did have a drop off in net income in 2017, but their free cash flow remained steady. So it must have been some non-cash items they passed through. Revenue looks good, increasing a lot, a big jump in 2019. Let's figure out the capital structure so we know what to discount the future cash flows by. The interest they pay on their debt is $149 million. That's on the income statement. Now let's see how much debt they have. We'll go to the balance sheet. We'll go to liabilities section. Under current liabilities, shows a current debt of $2.7 billion. And then they have long-term debt of $3 billion. And long-term debt is debt due beyond 1 year. Since interest payments are tax deductible, let's get their effective tax rate. Their income before tax on the income statement is, we'll use the 2019 because in 2020 they had negative income tax paid, so that won't really work. So in 2019 they had $2.8 billion of income before tax, and then income taxes of $461 million. So they paid 16% of taxes, so their cost of debt is 2.2%. Let's figure out their cost of equity. We need the beta for that. That's the volatility of a stock. And it's 0.96. So the stock pretty much moves with the market. Now we need a little more information from the balance sheet. Let's get the current assets. Current assets are mainly cash, accounts receivables, and inventory. We'll go to the balance sheet. Go to the assets. Current assets, $6.7 billion. And current liabilities are debts and payable that are due within 12 months. That's $10 billion. And then their equity, which is the total assets minus total liabilities of $7 billion. Let's look for their EBIT. That's earnings before interest and taxes, or operating income. That's on the income statement. That's $1.5 billion. Now to figure out the weighted average cost of capital, it's a blend of the cost of debt, which is 2.18%, and they have 45% debt in their capital structure. And you combine that with cost of equity, which is 9.69%, and they have 55% of equity in a capital structure. Weighted average cost of capital is 6.3%, and that's what we're going to discount the future cash flows by. So we estimated 4 years of future free cash flows, and we did a terminal value, which is all years past year 4. We discounted those numbers back to today's dollar amounts using the weighted average cost of capital. And we come up with the value of the company of $88 billion. We divide that by 419 million shares. And we get an intrinsic stock price of $209. It's trading at $150. So it's trading at a 28% discount. So it's a buy according to the model. Let's see what Simply Wall Street calculates. They're at $172. So they're also saying it's a buy, but it's 13% undervalued. Not as much as my model. But in both cases, we're both saying the stock is worth more than it's trading at. Looks like the stock was in the 200s a year ago, but it's come down a little bit, and now it's hovering around 150. So stock price is really based on supply and demand of the market. Let's look at their financial ratios to get more information on the company. Great PE at 9.8. I like to see under 15. The average in the market is 29, and the median is 16. So they're in good shape. That's price of stock over earnings per share. Not such a great price to sales ratio, 5.8. I like to see under 3. That's price to stock over sales per share. Their price to book is 9. That's also pretty high. That's price to stock over book value per share. They have a weak current ratio of 0.6. So that means they cannot cover their current liabilities. So they may have to go into more debt. This could be a timing issue. So if you look in the following quarters, maybe they'll fix this. Amazing ROE, 91%. So they're pretty much providing their equity holders with almost 100% return, which is really impressive. 10.2 interest coverage ratio. They can easily cover their interest payments. And debt of 45%, so a pretty decent amount of debt. The best way to look at ratios is to compare them to the competitors. So I've done videos on Adobe, Microsoft, Oracle, and Square. And this is VMware right here. And if it's green, the number, that means they're better than the average. And if it's red, they're worse than the average. And if you see anything in orange, that means that company has won in that category. So VMware has the best PE ratio of 9.8. Price to sales ratio, they're better than the average of 5.8. None of the companies have good price to sales ratios. Oracle is the best at 4.2. They're better than the average of price to book. They have 9.0. The average is 15.2. And they're not in good shape in current ratio. They're under 1. The average is 1.9. So VMware and Adobe are both below 1. ROE, VMware just knocks out of the ballpark at 91%. Nobody even comes close. Oracle has a really good ROE at 49%. The average debt is 44%, so they're right around average. All companies have a good amount of debt except Oracle. They're a bit leveraged. Anytime I see over 50%, I get a little concerned. And they're below the average in market cap. They're still a pretty big company, $62 billion, but when you have companies like Microsoft and Adobe and Oracle in the list, it makes your company look small. So let me know what you think of the video. Do you like these companies? Leave a comment. Thanks for watching.